Hi guys, welcome back to Quicklit Summaries. Today we are summarizing a book about finance, cause our lot of viewers need our summaries related to finance. So today we are summarizing our first book related to finance, The Intelligent Investor, by Benjamin Graham. And before starting the summary, I would like to tell you that this book is highly recommended by the legendary Warren Buffett. He read this book multiple times and advised people to read this book once in their lifetime or before investing their hard-earned money. So listen carefully. Introduction. The Intelligent Investor is a classic investment book by Benjamin Graham, first published in 1949. Widely regarded as the foundation of value investing, this book has influenced many successful investors, including Warren Buffett, who called it by far the best book on investing ever written. Graham provides timeless principles to help investors make rational decisions, avoid speculation, and build long-term wealth. He emphasizes that investing should be based on careful analysis, rather than emotions or market trends. This summary outlines the key lessons from The Intelligent Investor and explains Graham's philosophy on how to approach the stock market wisely. Investing versus speculating. Benjamin Graham makes a clear distinction between investing and speculating. He explains that an investor carefully analyzes the fundamentals of a company before making a decision, whereas a speculator bets on short-term price movements without understanding the true value of an asset. Graham warns that speculation is risky and often leads to losses, while intelligent investing is about long-term wealth building. He argues that the stock market is filled with people who speculate, hoping for quick profits, but true investors focus on stability, growth, and minimizing risk. Graham advises that if one chooses to speculate, it should be done cautiously and with only a small portion of their portfolio. The value investing approach. Graham introduces value investing as the foundation of intelligent investing. He emphasizes that investors should focus on a company's intrinsic value rather than its current market price. Intrinsic value is determined by analyzing financial statements, earnings, assets, and the company's overall financial health. He argues that the market often misprices stocks due to emotions like fear and greed, creating opportunities for patient investors to buy undervalued companies. By focusing on long-term value rather than short-term price fluctuations, investors can achieve steady and reliable returns. Mr. Market. Controlling your emotions. Graham introduces the concept of Mr. Market, a fictional character representing the stock market's unpredictable nature. He explains that Mr. Market is highly emotional. One day, he is optimistic and offers high prices. The next, he is fearful and sells stocks at a discount. The intelligent investor does not get carried away by Mr. Market's mood swings. Instead of reacting emotionally to price changes, Graham advises investors to remain rational, analyze intrinsic value, and make decisions based on facts rather than hype. The margin of safety. Principle. One of Graham's key investment strategies is the margin of safety. He defines this as buying stocks at a significant discount to their intrinsic value. This discount acts as a cushion, protecting investors from unexpected downturns, market volatility, or errors in analysis. The wider the margin of safety, the lower the risk of loss. Graham stresses that investors should never overpay for a stock, no matter how promising it looks. Instead, they should always seek investments where the downside risk is minimal compared to the potential upside. Defensive versus enterprising investors. Graham categorizes investors into two types based on their risk tolerance and effort level. Defensive investors prioritize safety and stability. They prefer a passive approach by investing in diversified portfolios, blue-chip stocks, and index funds. Their focus is on minimizing risk rather than maximizing returns. Enterprising investors are willing to put in more effort to research and analyze stocks. They actively seek undervalued companies and attempt to outperform the market. However, Graham warns that this requires discipline, patience, and a deep understanding of financial statements. He advises that individuals should choose their approach based on their temperament and willingness to study the market. The importance of diversification. Graham stresses that diversification is essential for reducing risk. By spreading investments across different sectors, industries, and asset classes, investors protect themselves from the failure of any single company. He advises against concentrating too much capital in one stock, no matter how promising it may seem. A well-diversified portfolio helps balance risk and provides more stability during market fluctuations. The impact of inflation and bonds. Graham highlights inflation as a hidden danger that slowly erodes purchasing power. He warns that cash and low-yield investments like bonds may not keep up with inflation, reducing real returns over time. To counteract inflation, he recommends a balanced portfolio that includes both stocks and bonds. While bonds provide stability, stocks have historically outperformed inflation in the long run, making them essential for wealth growth. Avoiding market hype and speculative trends. Graham warns against following market hype and speculative trends. Many investors get caught up in bubbles, buying overpriced stocks simply because they are popular. This often leads to losses when the bubble bursts. Instead, he advises investors to rely on fundamental analysis rather than speculation. Buying stocks based on hype rather than value is a dangerous strategy that often results in financial ruin. Patience and discipline in investing. Graham emphasizes that successful investing requires patience and discipline. The stock market is unpredictable, and short-term fluctuations can be misleading. Intelligent investors do not panic when prices drop or get overly excited when prices rise. He advises that building wealth takes time, and the key is to stay committed to a well-thought-out investment plan. The market will have ups and downs, but those who remain disciplined and stick to their strategy will achieve long-term success. Conclusion. In The Intelligent Investor, Benjamin Graham provides a roadmap for rational, disciplined investing. He teaches that true investors avoid speculation, focus on intrinsic value, and maintain a margin of safety to minimize risk. Whether one is a defensive or enterprising investor, the key principles remain the same. Be patient, diversify wisely, and ignore market hype. Graham's teachings remain relevant even decades after the book's publication. While investing strategies have evolved, the core philosophy of value investing continues to guide successful investors today. Following Graham's principles can help anyone build a strong financial future while avoiding the pitfalls of speculation. That's it for today's summary of The Intelligent Investor. I hope you found these insights valuable. If you enjoyed this, don't forget to like the video and subscribe for more book summaries. And let me know in the comments, what book should I summarize next? I'd love to cover the books you're most interested in.